Exchange. Tracy, thanks.
Thanks, Dave.
The last 3 days of trading of last week saw one of the worst performances for the stock market in about 5 years for that 3-day period. And one of the themes which we've developed on this program is, where do you go for a safe harbor? How do you look for a little safety when you've got that kind of sell-off in progress? Well, with some answers, concrete investment advice we bring in today. Scott Keys, president and founder with Keys Financial Advisory Corporation, and James DePore, author of, and I like the title of this one, Invest Like a Shark. I've got to go to you first, Mr. DePore, with a title like that. You invest like a shark in a downside market like this, and that's how you get your safety? Tell me.
Well, the nice thing about a shark is when there's danger, he doesn't hesitate to leave. The shark's aggressive when it's a good time to be aggressive, but he also will exit when there's danger in the waters. So in a market like this, the safe thing to do is simply exit.
Exit? Okay.
Everything?
Go to cash.
Really?
Go to cash? But that's market timing. Anybody over time, James says, that doesn't work because your gut tells you to sell at the wrong moment and then buy at the wrong moment when everything's frothy.
No. There's a fallacy that if you try to time the market, that you're going to be out when the market is up. And in fact, one of the fallacies that you see all the time is that if you miss the 5 biggest days of the year, that you're going to underperform tremendously. Well, most of the biggest days of the year come after severe drops. The biggest rally in the past 20 years was the day after the crash of 1987. If you miss that, then you're far ahead. So timing is, what's more important is having a methodology.
Okay. You know, one thing we like on this program is clean-cut answers. And you just gave me one of the cleanest of clean-cut answers we've had in a very long time. So let's bring in Scott Keys. See if you can match that. I'm not asking for the same kind of advice, but look, I want a port in this storm. I want a safe harbor. What says Scott Keys?
Well, and as opposed to market timing, we believe in virtually any market, there's still areas that are going to be doing well. So a few areas that we like right now, for instance, are healthcare, where you've got reliable earnings growth. The demographics are very favorable for healthcare. We've also got a very strong global economy going on right now, Stuart. So we believe that companies that are deriving a large portion of their revenues from overseas markets should continue to do well. So in the industrial side, companies like Manitowoc that are diversified geographically as well as by sector. On the technology side, companies like Cisco, Corning. We believe all of these are great places to be right now.
Okay, that's all good stuff. I'm hearing you. Overseas-based companies, healthcare, and some technology issues. I hear all of that, and those are themes which we've developed on this program consistently over the past week. All right, now what about buying some of the deeply depressed financials? Citigroup, for example, yields what? Close to 7% at its current price? You wouldn't touch that with a 10-foot pole?
No, I wouldn't right now, and I'll tell you why. I would look for some sign that we're close to the bottom of these write-offs. In my mind, yeah, these stocks are cheap, asserting that the earnings continue where they are, but I think there's still way too big of a chance. You've got larger write-offs coming down the road. I would look for a sign where they're starting to upgrade their earnings as opposed to downgrade their earnings. You're starting to see things move forward where we've reached the bottom in this credit crisis. I don't think we're anywhere close to that.
I'm going to interrupt you for a second, Scott, because the shark right here is nodding vigorously.
Nodding. What are you nodding at?
There's no such thing as a safe stock. There is no such thing. What makes you safe is your approach to the market, your methodology, and whether you take a stock like Citibank. Now, whether that's safe or not depends on how you handle that investment. If you simply buy it and sit there even though it continues to go down, well, that's not very safe. But if you buy it and then manage that investment by maybe adding when it starts to go up and things like that, that's how a systematic shark approaches the market.
Well, let's say you bought Citibank today, and so if you're looking for a sell signal, how much would it have to fall in addition after you buy it to get out?
Well, there's a lot of different methodologies you can approach. I mean, I use charts. I use support lines, resistance lines. You might just put a 5% stop limit on it.
Where would you put new money right now, other than cash? Anything out there around? You got the whole world open to you. Where would you put new money, other than cash? Other than cash,
I would probably go into some oils at this point. I still like the precious metals and mining. I still think those are going to go. small caps have been underperforming for the entire year, and I think they may finally see some of the seasonal strength that we see at the end of the year.
To invest in oils at this point is a strange behavior for a shark, but nonetheless, we appreciate you being with us. Thank you very much indeed, James DePore, and indeed Scott Case. Again, thanks very much for being with us. Appreciate it, gentlemen. Okay, taken.
Thank you.
Well, speaking of something that's